Hi guys, welcome back to my channel. This is me again, Arnel, and today we will discuss about prepaid expenses, accrued expenses, accrued revenue, and unearned revenue. So I set this table for you to realize what are the differences of these four accounts. Okay? Prepaid expenses are those expenses already paid. Your prepaid expenses already paid from your supplier or for your service provider, but not yet incurred. This is something like you pay in advance or pay deposits to your customer or to your service provider, and the service provider will render their service on a staggered basis. So since you pay in advance to your customer, you have to account this under asset in your financial statement or in your balance sheet. And example of this is prepaid insurance. Insurance company usually requires you to pay the whole year subscription to be paid on the beginning of the year. Although this insurance is applied on a staggered basis, on a monthly basis. So if it is paid on the beginning of the month, you should record under prepaid insurance and record under assets. Another example is prepaid rent. If your business is like for example store in a mall, and mall requires you to pay 12 months advance payment for the rent, so this is booked under assets because you pay in advance but the service is not rendered for you, so you have to recognize as under assets because no expenses yet. Okay, so how to record initially prepaid insurance? So we have debit and credit. In debit side, you have to record the prepaid insurance and credit cash. Let's say 12,000. Okay. Let's say you pay on January 1, 12,000. So you have to debit prepaid insurance and credit cash. And on January 31, you need to prepare financial statement. So you have to reverse prepaid insurance. You have to recognize now the expenses related to insurance. So we have debit again and we have credit. And at this time, you need to credit the prepaid insurance. You have to recognize the expenses. So your debit will be insurance expense. Let's say the 12,000, so 1,000. Now, if you prepare a balance sheet, your balance sheet under your insurance, prepaid insurance in your balance sheet will become 11,000, and 1,000 insurance expense will be part of your P&L as expense. Okay? We move to accrued expenses. In accrued expenses is already incurred but not yet paid. This is something like in reverse of the prepaid expenses. So in this case, the services already rendered to you, but you didn't pay yet. So you have to record under liability. Usually this is current liability. And like for example, accrued wages. Accrued wages. Why accrued wages? Like for example, you are usually paying your employee on the 5th day of the succeeding month or on the following month. So meaning this wage is incurred on the month of January, but you have to pay on the month of February or February 5th day of the February. So in this case, the expenses already incurred but not yet paid. Another example is the taxes. Government require you to pay the taxes on the 20th day of the following month from current month. Let's say today is January 2020. Government require you to pay on February 20. So meaning the expenses is incurred on this current month, but the government requires you only to pay on the 20th day of the following month. So in that case, the expenses is already incurred but not yet paid. So how to record this kind of transaction initially? Initially, you have to, let's say we have debit and credit. So in this case, you need to recognize the expenses. So we'll do the entry for the accrued wages. So wages, expenses, and wage payable, or accrued wage payable, or accrued wages, like that. So it depends on your company or nature of your business, how you use the accounting terminology. But let's say in this case, we have to debit wage expense to recognize expense at this moment or in this month, and you have to recognize your liability. It will become part of your P&L, and this will become of your liability on your balance sheet. On 5th day of February, on the following month, you have to pay now your employee. So the subsequent entry will be accrued wages. Initially you recorded as credit, now you have to debit to offset your payable. And of course, you have to record cash because now you're paying to your payable accounts. Okay, now we'll move to accrued revenue. In accrued revenue, this is actually related to your revenue in your company. So accrued revenue, this is already earned, but the payment is not yet received. And then in this case of transaction, you have to record as asset. This because you already rendered your service, but the customer is not paid your company. Like for example, you're in the bookkeeping company, bookkeeping service company. So meaning, based on your contract with your customer, you have to bill them on a 10th day of the following month from current month services. So meaning, if you are preparing the financial statement on end of the month, you have to recognize the revenue because you already rendered your services, you already incurred the expenses related to this service. So to match or to comply with matching principle, you have to record the revenue related to the expenses you already incurred. Okay, that is one. Another one is accrued interest income. Accrued interest income. This is another. If you are lending in lending company and you have you are calculating or you're billing your customer on the succeeding days on the following month, like for example, third day of the following month. So of course, the interest you already earned in this current month, but as agreed based on the contract, you have to bill them only on the third day of the following month. So it's you have to record now the interest because this is earned on the current month. So to record the initially the accrued revenue, you have, let's say, debit and credit. So this is accrued bookkeeping services, service and service income, or whatever the your company use accounts, but it should come to it should come to as part of assets or same as receivable, and service income will be part of your revenue in your P&L. Subsequently, you have to collect now the money, so, or the payment, so you have to record again. Now you are receiving cash against these bookkeeping services, and you have to reverse now the accrued accounts, accrued bookkeeping services. To offset or to zero out this account, accrued bookkeeping services, you have to credit this time subsequently, let's say on the third day of the following month. Okay, now we move to unearned revenue. In unearned revenue, this is in reverse to accrued revenue. The unearned revenue is payment already received but not yet earned. Meaning, your customer gave you the advance payment. Let's say, for example, you are in the book magazine subscription. Like for example, your business is a publishing company, and your customer, usually you're collecting your customer on the beginning of the year for the subscription for the whole year. So meaning, it seems like it's same like deposits from your customer. So what we call this a subscription. So in that case, because you receive in advance the payment from your customer, but you didn't render any service yet for them, so you have to account this as liability or current liability, because the money you receive in advance from them. Okay, if you're like for example you're a school, so you have tuition fee. So you receive payments from your students, a tuition fee, like for example, good for 6 months or one semester. So they give you payment on the beginning of the school year, but it should be applied for the 6 months or for the one semester. So you have to record in a staggered or a monthly basis, depends on the or because it's payment good for 6 months, and you didn't exert any effort yet for the services, or for the or your school didn't teach the student yet. So it's like deposits only, and we have to record as liability. So initially, how you record the subscription once you receive the money from your customer. So debit and credit. So you receive cash. So you automatic you have to debit the cash, and credit is unearned subscription, or you can call it prepaid subscription, or whatever your company is using, how they use the accounts. But the important here, you have to debit the cash. It will come part of your balance sheet, and under current assets, of course. And you have, at the same time, you have to record unearned subscription or prepaid subscription under liability, because at this moment is still liable to your customer. You didn't earn this subscription yet. Now, come after 1 month, or every time you're preparing your financial statement, you have to analyze the subscription. Is it applicable? Like for example, the subscription is good for 3 months, and you prepare your financial statement on a monthly basis, so you have to allocate partly those subscriptions already earned or lapse already. So how to journalize? So you have to record unearned or prepaid subscription and subscription income. Sorry, they don't have more space for this, but if you debit the unearned subscription, you are reducing the balances of unearned subscription. If you prepare a T account, it will be debit side of the T account. So if you get the balance, it will reduce based on the subscription this month. And credit subscription income, now you have to recognize now the income, because maybe you delivered some newspaper or some magazines already to your customer, so this is recognized now as subscription income. Okay, hope this table or summary will help you, because I remember when I was in college, my teacher also teach me this way, and he gave us this table. What I did, I put in a small paper and pasted on wall of my in my room. So every time I wake up, I see this one, because if you are a student, believe me, it's hard for you to memorize, because accounting is not only subject you are trying to cope up every day of your life. So what I did, because this is something like unique for accounting, and you can use only this in accounting. There's no account like this in other courses. Thank you for watching my video. See you in my next vlog. Bye bye.